All right, welcome to the Money Puzzle. I am Brian Ramsey, and you guys are
Chris Vaughn.
Oh, that's your name? I forgot.
Yeah, that's what it was. I am never going to live this down.
no,
It's Eric Douglas, of course. So.
yeah, no. Why we're giggling is because Mister forgot Eric's name, so it's pretty.
You were struggling there for a second.
No. I know who we are, but it was funny, and he'll absolutely never let that one down.
Oh my gosh! Oh
No, I know.
Well,
Anyway, so today we are talking about the Federal Reserve and raising rates. It's been all the conversation for the last 2 months, probably a month or so.
yeah.
Well, really even going back to November when they first announced they were going to be raising rates.
Yeah, Yep, exactly. So what we're going to talk about is sort of how the Fed affects rates and how the rising interest rate affects the market. So those are kind of the two things we're going to talk about. First and foremost, if you are watching, Miss Producer is going to pop our phone number up. If you're listening, our phone number, 502-200-5210. And as always, if you hear this podcast and you go, hey, this is a pretty interesting conversation, I'd like to know how this affects my portfolio and what I can do to hedge against the rising interest rates, come see us. You've got the phone number there. Call. Miss Whitney will align you with one of us, and you can come in and meet with us. Probably multiple of us in that case. But all right, so let's talk about the Federal Reserve to begin with. All right, so there's a lot of misunderstanding about how the Federal Reserve works.
Okay.
Right. So let's take 5 seconds. It'll be a little more than 5 seconds. A couple seconds to talk about generally how the Federal Reserve actually works, because it also not only do they affect interest rates, but they affect the money supply. But they don't affect the money supply as in giving money out. They just affect how the flow of money works.
Right.
So here's kind of how it works. So the Federal Reserve, what they do is they charge a rate to banks. So generally speaking, a bank, and the numbers are not going to be right, but you'll get my point. So the banks, when they lend money out, we have a bank right across the hall, by the way. When they lend money out, they have to have a certain amount of deposits to support that lend.
Right.
Okay. And just for easy math, I don't know what the ratios are, but let's just say for easy math, they have 10 million in outstanding loans and they have 11 million in deposits.
Right.
But the bank says for you to be in balance, you have to have 12 million of deposits. So they, in theory, at the end of every day, they have to have $1 million in deposits. Well, they don't have it because somebody came in, withdrew money out of their account. So what the banks do is they go to the Federal Reserve and say, I need $1 million credit on my account to keep me in balance. Federal Reserve says, that's fine. We're going to charge you this rate of interest, which is what we're all talking about right now. So what happens is the Federal Reserve raises rates. Why they do that is because they try to get banks to not lend as much, right? Because banks may say, so Chris may come in and say, hey, I want to borrow $1 million. And the bank says, so two things affect. The banks may say, okay, well, it's kind of right there on the edge. I may not lend to you, right? That's how because if I then lend $1 million, that means I have to go to the Federal Reserve and borrow the money to keep in balance, and then I have to pay that interest. So they may not do that. However, Chris may say, I need to borrow $1 million. And the bank says, okay, I have to pay that 3% or whatever the Federal Reserve lending rate is. So therefore, I'm going to charge you 6.5% for that loan. Chris may say as a business owner, well, that doesn't make a lot of sense for me to even borrow the money because I can only make a projected 7-8% return on this investment that I'm going to make. The spread's not there, so then I'm just not going to borrow the money, right? That's kind of how it works. So what happens is the Federal Reserve, they lower the rate. Then all of a sudden, Chris coming to borrow money from the bank says, okay, now I can borrow money at 3%. I can now make 7% on this project. That makes sense for me to do it. I borrow the money and then I get money into circulation in the economy. Generally speaking, that's how it works. Now, how do banks react to that? Banks will say, okay, I now have to raise more, pay more for this deposit that I have to get every night. So therefore, all my loans that I make, I have to increase the rate.
Right.
But also, I need to attract deposits, right? I need deposits because I don't want to pay this crazy loan to the Federal Reserve. So therefore, I'm going to make my savings interest more attractive to depositors. Right. So they increase the rate. And that's honestly why you'll see sometimes you drive around town and you'll see a little thing out front of a bank and it'll say 3.3%, on your deposits. Why do they do that? Because they need deposits.
They need the deposits.
They need deposits. That's why you hardly ever see a JP Morgan Chase or a central bank, whatever, have that out front because they don't really need the deposits that bad. But you'll see smaller institutions do that. Now, that's kind of generally speaking, that's how it works. Okay. So now let's talk about how that translates over to the fixed income world. So entities that go borrow money, okay, how do those bonds, how do they react when it comes to rising interest rate environment?
You're asking me?
Eric,
Okay,
yeah,
so
Eric, you look like you're getting ready to talk.
So basically, there's an inverse relationship. So if you're raising interest rates, what you're basically raising interest rates on is the yield, or what you're paying to a bond holder. And if you are a bond holder, you own debt. So if I am a company, there's two ways to raise debt. I can issue stock or equity, and let's say I'm giving you ownership, right? So you own a piece of the company. The other way that I could raise money as a company would be to issue debt.
Right.
And you would basically become a credit holder. And so I would take your money and then I would pay you back with interest. So when interest rates go up, I have to pay you back with more interest because in order for me to borrow money, I have to pay more interest out, right? Or that's what the banks are doing essentially. So what's happened this year, and it's been especially prevalent this year because that's what's been really, really bad about this year's market. It's not so much the equity market that's been, of course the equity market's not been great, right? But what's been really bad about this year, or very unique anyway, is that the fixed income side of your portfolios has really fallen almost as much as the equity side. The reason that's happening is because with interest rates going up so suddenly, what that happens is if the interest rates go up, there's an inverse relationship to the value or price of a bond. So the price or the value of bonds are going down at the same time the interest rates are going up. So you're seeing just a sudden decrease in the value of all of these bonds that are sitting in all of your portfolios. So everyone talks about the traditional 60-40 moderate portfolio. If the 60% stocks portion, right, that's going to go up or down. In theory, that 40% is supposed to kind of stay level. And really, historically, it's supposed to get you about 4 to 5, maybe 6% return. That's not happening. Bonds, I just looked at the number this morning, as a matter of fact. The Barclays aggregate bond index is down 10% year to date. Well, that's not safe.
Right.
That's supposed to be the safe haven in your portfolio, and that's what's happened in the market in a nutshell. And even to expand upon what you were talking about, the reason why the Fed, we didn't really talk about why the Fed's raising rates so suddenly.
Right.
Well, what's happening in the world right now? Inflation. Inflation is horrible. What was the last number? Actually, it just came down like
8.3 was the last one.
Yeah, it came down like 0.2% from April, or I'm sorry,
Yeah,
from
it
March.
was 8.5 in March, 8.3.
Yeah, so it's 8.3 in April, but still, that's just a horrible, horrible number year over year. Well, the only thing that the Fed can do to fight inflation is to raise interest rates, because what you were talking about, when money is so cheap to access, by cheap, I mean when interest rates are so low, and I'll just use your mortgage as an example. When you go to take out a loan on your home or to buy a home, if the interest rate is 2.5%, well, you're not paying nearly as much interest on that debt, so you're able to afford more house.
Right.
So you go out and buy a more expensive house. The more and more that happens, that drives real estate prices higher and higher because more and more people are able to borrow more debt to finance a larger investment.
And the case in point of how that's happened is the bidding wars that you've had on real estate all over the country the last, couple of years, really.
Yep. And so the way that you fight inflation, and I'm just using the real estate example, real estate as an example, but you fight inflation by raising interest rates. So debt isn't as easy to obtain.
Right.
So that means you borrow essentially less money, which in turn, over time, is going to eventually bring prices down a little bit lower. The same thing works in the business world.
Yep.
If you are a company financing your growth, you once again finance growth through stocks or issuing bonds, issuing debt, or taking on debt to grow your company. So I take on a loan. If I can take on a loan at 2-3% to finance growth in my company, I'm paying a really low amount of money in interest to a bank every month. Well, if I have to raise my interest payment, you used that example earlier. If I'm having to pay 6%, but I'm only going to yield maybe a 7 or 8% return on my investment with what I'm doing with that money, maybe I'm going to think a little bit longer about whether or not I should take out that debt.
Yep. I want to go a little bit. You were talking about the inverse relationship between rising interest rates and the value of bonds. So we're talking about the income portion of our portfolio. I think this is where a lot of people get lost. They don't understand why that works.
Yeah.
And just to kind of give an example of if you think about it, if I own a bond, and let's just say that bond is paying. Remember, I own another company's debt. That bond is paying me 2.5%. right? So I'm getting that 2.5% interest payment off of that. But just like with mortgages, you can buy and sell that bond. So now new bonds that are coming out because the interest rate went up, they're say paying 3.5%. Well, my 2.5 is not as attractive as 3.5 I can get on a new one, which means I'm less interested in holding it, but I'm also going to have trouble selling it. Why would either one of you all buy my 2.5% bond when you can get a 3.5% bond for the same price? Which is why you're getting this inverted flow.
So essentially,
right?
if I wanted to buy that 2.5% bond from you, I'm going to pay you less money.
Less money. I'm going to have to sell it on the cheap.
So when I talk about the value, that's where I mean the value of that bond is decreasing because it's paying out less money now. It's not as valuable.
That's exactly right. And that's the reason why when interest rates from the Fed go up, when that discount rate goes up, the bond markets go down. And back to your point, when equities are falling, usually one of the safe havens would be the income market, the bond market, but they're falling at almost the same rate right now, which is
it's bad.
That's the reason people are feeling so much pain.
Yeah, it's tough, and I will tell you that we've had a lot of clients that have come in. One from our TV show that we have, which comes on every Saturday morning at 10:30 on WHS, the ABC affiliate here in Louisville.
Nice plug, by the way.
Yeah, hey, yeah,
That was
and
well done, yeah.
it's also on our website. It's also on YouTube. So if you're not local, you can certainly look it up. And we know there's folks from out of town watching that because we hear from you guys. So I appreciate the feedback. But we've had a lot of folks over the last several weeks that have walked in the door that have said, "What is going on in my portfolio? Right? I'm losing money like crazy. In all reality, it's just a temporary feeling because the markets have dropped off. But we got portfolios down 6, 7, 8%. People think the world's falling apart. But it's tough when you open up your statement, and that's what's driving them in here, right? Yeah. They open up their statement, they're like, "Oh my gosh, what am I doing
What's
wrong?"
happening? Yeah.
And so they come in and they say, "Hey, can you do a full review?" And we look at it and we just explain to them exactly what we're explaining to you right now. It's the fixed income portion of your portfolio that's really kind of getting beat up right now. So again, I tell you that because if you want to be one of these folks that does walk in the door and say, "Hey, what's going on?" or "I just want a second opinion," maybe you work with another advisor and you're just like, "Hey, I just want a second opinion," by all means, come see us. We had a lady last week that actually works with an advisor that saw our TV show and said, "Hey, I want to come in and do a review." So she came in and she was very upfront and said, "Hey, I already work with an advisor." We're like, "Yeah, that's fine." So we did. We actually.
In fairness, most of the people that walk in the door
already do.
Yeah, that's true.
Right.
That is very true. Although we had the one guy that did, right?
Every now and then you find someone who has.
But anyway, she came in. She's like, "Hey, I do work with somebody, and I've been with the guy for a long time, but I just want a second opinion, right?" And so we did a full portfolio analysis and a fee analysis, and we showed her, "Hey, this is what's going on." We didn't say anything critical about it, right? We just said, "This is what's going on." And
here's the facts.
Yep. And she said, "Well, how do you guys do things?" And we're like, "Well, here's our existing portfolio. It's a portfolio that we have managed for a number of years with existing clients." And there was a significant difference. I'd say it wasn't dramatic, but it was a significant difference.
Right.
And we just showed her the cost comparison, and she wound up saying, "Hey, I'm interested in doing business with you guys." So if you're one of those folks that say, "Hey, I'd just like a review," come and see us. We can do the exact same thing. We didn't charge her anything, and we weren't pushy or anything. We just said, "Hey, we'll just do the analysis and give you the information." And so if you find yourself in that position, by all means, come and see us, and we'll do the same for you. So, all right, any last final thoughts?
Well, I was going to throw another section in. This may be a little bit too much, but when we talk about the markets are going down,
because that's how you are.
That's what I do.
Yeah.
The income portion is going down. What are some of the options that people have? What can they do instead of that? And historically, this is where people start talking about commodities, gold, silver, things like that. Some of the other things, we've had this discussion recently, is utilities are what's called a defensive holding. When the markets go down, people usually do still keep their air conditioning and their heating running. They still keep the lights turned on. So the utility companies are usually a little bit more stable. Those are just some of the things, if you all wanted to go a little bit further into that, we can. Some of the things that you can do when that fixed income space is not the safe haven that you're expecting.
Yeah, so I mean that's where the planning comes into play,
Yeah,
right?
exactly.
And so I think one of the reasons I've been very, very, very pleasantly surprised with how few clients of ours anyway, have really had any issues is because we've done so much education on the front end.
Right.
to talk about, this is what's happening, this is what could happen, but we're putting them in portfolios that are catered to their risk profile. So we're not taking on any additional risk that they're not really comfortable with. Do we like the fact that the fixed income environment or the bond funds are doing as poorly as they are this year? No,
not.
but they're not doing well anywhere else. I mean, this is the problem industry-wide. All that to say, we've done some things within our portfolio. I think it's fair to say, if you are working with someone, you should make sure you're going to them and having discussions around what exactly are they doing to hedge against inflation? What are they doing in light of the Fed raising interest rates? And how are they navigating this? Really, it's a historical era, to be perfectly frank. I mean, this is the worst. I saw a stat, the first quarter of 2022 was the worst start to a year that fixed income has ever had. So this really is, something new that we're all navigating, but it's definitely something you want to make sure, if you do work with someone already, make sure you ask them what they are doing to address it, or how they're going to address it in the future. All that to be said, you don't want to overreact either.
Right.
We've done some things in our portfolios, but we haven't moved completely away from bonds.
Right.
They will rebound. There's maybe some potential signs that that's starting to happen to some degree. So you don't want to overreact on one end or the other. We always want to think as logically and rationally as we possibly can and try to remove emotion away from it. I know when clients come in, it's their money. It's a very emotional.
It is emotional.
It's very, very emotional, and we certainly respect that. But we try to be as rational as possible when we're putting together portfolios and discussing and walking clients through the financial planning process.
Yes, on a totally side note, I've been completely distracted. Right outside this window, there is a walkway across the little street that's right in front of our road, and it's yellowed off, meaning it's like painted to show you that it's a walkway, but not that many people know there's a little bit of a hump in there. And this guy just came flying down through there and hit that hump. I'm sure he's like, what in the world was that hump there? But I saw the car kind of bounce, and I thought, well, that guy had no idea that was a hump in the road.
Having a squirrel moment over here.
I was having a squirrel moment there. That was hilarious.
Thanks for paying attention to me.
Yeah.
He can't remember my name, and you can't pay attention to me. So.
Oh, I know. Well, it's just interesting.
It makes you feel important.
Nothing but love in this office place.
Anyway, all right, so we'll wrap that up for today. Just make sure that you tune in every week. Make sure you like and subscribe. And I'll let Eric kind of send us off in a second. But just know that we do have other podcasts. We have a TV show that comes on every Saturday morning, 10:30 on our ABC affiliate, WHS. You can catch that at our website or online at YouTube. Just search The Money Puzzle. You'll see it. And we also have another podcast we're getting ready to do here in just a few minutes called Burgers and Bourbon, which we're trying to rename. But basically, we taste a bourbon. It's basically just a way we can end a Friday afternoon is to sit around and drink bourbon in the office. Not a lot of it, but we do taste it from time to time.
Notice how you put that qualifier in there, right?
We do,
on camera anyway.
Right.
Yeah.
We do have a couple that are pretty good. They each have stories behind them. At least, I don't know if we're going to do the second one anyway. But anyway, so make sure you tune into that. And again, if you find yourself in a position where you want a second opinion or you're just not sure what you should be doing inside your 401k, like we talked about last week, if you had some, you just say you don't ever look at it, but you want a professional to take a look at it, or if you just want us to, hey, take a look at your portfolio and see, what you should be doing to hedge inflation or how to fight the Fed or anything like that, make sure you come in and see us. We'll be happy to sit down and work with you. And I'll let Eric sign us off for another week.
Yep, give us a call, schedule that review at your earliest convenience. Otherwise, thank you very much for listening to us today. On whatever platform that you are listening to us, make sure you leave us a rating, leave us a review. We greatly appreciate it. If anybody in your friends or family or network of people that you feel that they might benefit from any of the content that we're putting out or anything that we have to say, I can't talk today.
That's okay. It's Friday.
Over my
we're getting ready
words.
to drink bourbon.
It's Friday, right.
But anything that you think that we are talking about is relevant to anybody that you may know, if you could share our content with them, we greatly appreciate that as well. Thank you very much for listening and watching and spending some time with us here today.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.